You may think that having a savings account in a bank is just about everything you need to do to be a responsible saver. Listen to additional and helpful knowledge from Steve that takes the practice and discipline of saving and compounding to a deeper level of understanding.
I once sat in a meeting with a good friend of mine that I'd known since high school. He and I had grown up together, shared many experiences, and we'd earned a deep and abiding respect for each other. During this meeting, he expressed to me his investment concerns and asked point blank what the magic was that made the guys on Wall Street rich. I explained to him that A, the guys on Wall Street usually don't get rich from investing, but rather from selling things to investors. But with that said, there was B, and that is that smart investors understood that there is a magic bullet. One so simple we learned it as children, one so profound that it stands the test of time, and one so effective it's made fortunes of people ranging from the Rothschilds to Warren Buffett. What is this magic bullet? What is this concept, simple and elegant, a concept that works for virtually everyone, every time, and if properly used, is the only guaranteed principle that will make you wealthy? Well, let me answer it this way. And many of you have heard this and will therefore know the answer, if not the exact numbers. To one man, I offer $1 million in cash today, right now. He shakes my hand, and in return, I hand him a bag with $1 million in cash. Not a bad payday. To his friend, I offer her 1 penny, but I offer to double it every day for 30 days, for 1 short month. She and I shake hands, and I give her a bright and shiny, newly minted penny. Well, you can guess where I'm going, of course. At the end of 30 days, who has more money? Does the man who I immediately handed $1 million, or the woman who I so generously offered 1 penny with the guarantee to double it every day for 30 days? If you haven't guessed it, the answer, of course, is the woman who compounded her money at 100% per day for 30 days. At the end of the 30-day period, her 1 penny gift would total over $5.6 million in value. Now, I'd be happy I didn't make that agreement for even 31 days, because at 31 days, it would explode to over $11 million. This is the nature of compounding. It works every time, and it is the magic bullet you need to understand if you're to become financially secure. But the opposite side holds true as well, negative compounding. When you're in debt, and we've talked about that in prior sessions, you're paying the creditor the compounding effect, so it's very much working against you. And sad but true, my guess is you're paying your creditors a compounding rate much higher than you're able to receive through investing. Think about this using the example we just visited. To the extent the woman who received the penny, which then compounded for 30 days and became a small fortune, enjoyed that, someone on the other end paid for it. So when you're borrowing money, you're the one on the paying end. This is one of the driving reasons we so constantly harp on the idea of not having debt, especially credit card or unsecured debt. The interest rates on these debts can run as high as 25% or more, and with that type of rate, it's quite impossible for you ever to get out of debt. And you're going to keep transferring your wealth to that company in perpetuity. So the question you have to ask yourself, and be honest, is would you rather be the recipient of the compounding effect or the payer of the compounding effect? It's that simple. That is the magic bullet. That is the single concept that you can bank on, retire on, become wealthy on, and only if you have the self-discipline to practice it. There was a young man once in New York City who hailed from a wealthy family. He grew up on an estate in Westchester County, went to the finest schools, attended all the best business schools. After graduating, he went to work for an investment bank and began making money, and very good money at that. But as he was just beginning life, he found he needed a little more cash than he was generating, so he began to use his principal or his capital to fund his increasingly lavish lifestyle. One day, he was having a wonderful lunch at one of those fancy restaurants in Midtown Manhattan with his girlfriend. Having paid the maitre d' a little extra, he and his fiancée enjoyed a wonderful window view of Park Avenue. As they poured the second glass of imported European water, our young friend looked out the window and saw what looked like a homeless person digging through the trash can on the side of the street. From his vantage point, it looked like that person was collecting cans. Ha, that'd never be me, he thought as he sipped his $10 glass of water. As the meal went on, he watched this beggar with increasing interest. Who was this person that had a certain air about them? They didn't look really poor, just out of place. In fact, this person looked somewhat familiar. He watched a little longer. Finally, the beggar looked at him and smiled, and in an instant he recognized her. It was Aunt Elizabeth, his father's sister. What? He thought. Aunt Elizabeth is worth millions. What in the world is she doing out there? So he politely excused himself from the lunch table and walked outside to question his aunt about her behavior. He approached her on the street and asked with extreme curiosity, "Aunt Elizabeth, what are you doing out here?" She looked and said to him, "Young man, let me tell you a fact of life you need to live by no matter what." "Well, what is that?" he asked. She said to him, "This is the secret that made your grandfather so wealthy and sustained the wealth for your father. Without this, you will squander through your fortune, if not now, then certainly by your children's generation. The fact of life is never, ever, ever spend your principal." And this month, I'd already spent my income, so I had nothing left until next month's check comes in. So I'm in a position where I scavenge to survive until next month. But then at least I'll be 100% again. If I spend my capital, I inversely compound the money and it will go away rapidly. Then I'm permanently out here scavenging. This shocked the young man, of course, but as he reviewed his life and went back that night to look at his expenses versus his income, he realized this day's random meeting was virtually meant for him. He had been living beyond his means, not by much, but by a little, and he realized that if he didn't stop, there'd be nothing left for his children. Well, how many of you have heard of Rich Dad, Poor Dad? This work by Robert Kiyosaki was his best effort at explaining why some people are rich and others aren't. Clearly, in order to understand this difference in people's outcomes, you have to start with the notion of not spending all of your income and therefore retaining some of your earnings. But you also must add to this a fanatical belief in the power of and the cost of compounding. Let's assume for a moment that you can compound your money at 12% per year. Now, granted, by most measures, this is a pretty good return. Now, we'll cover more on investment expectations later. So, it's a beautiful day and we saunter down to the furniture store. We've always hated that dining room set we have, and this really nice one is on sale for only $7,500. And best of all, the nice folks at the Furniture Mart will sell us that dining set on contract, so we don't even have to pay a dime today. Oh, yippee, we get what we want for free. Okay, come back to earth. What did that dining room set really cost? First, you have the actual cost of the bill, $7,500. Oh, wait, but let's assume that rather than consuming that $7,500, we truly invested it at 12% for 20 years. What would it have been worth then? Well, after 20 years, that $7,500 table cost you almost $65,000. Oh, but wait, that's not all. Let's add in the $1,500 we'll pay in interest, assuming they're charging only 19% or whatever over a 24-month payment. So we've spent over $65,000 and not even thought about it. So is it any wonder that some people are wealthy and others aren't? And by the way, that's only at 12%. What if you're really good and can get, say, 15% on your investments? Then that $7,500 table cost you over $100,000. Okay, now I understand that some of you are saying, well, that's ridiculous. On that metric, a $20 lunch actually cost me $285. So with that, I'd never spend a dime. Well, guess what? You get it. Quit spending so much on things that consume your hard-earned wealth. Fact, and I say this time and time and time again, we in the United States earn plenty of money, but the way we handle it leads to the vast majority suffering from major financial problems when they need it most, when they get older. Did you ever wonder why so many people go into banking and finance as a business? Did you ever think about that? Well, maybe, just maybe, they know something you don't. Well, you know what? They used to. But now you understand as well as them the magical concept of compounding interest, compounding returns, and negative compounding of costs. Who wouldn't want to be in a business where they can borrow money at, say, 8% and loan it to you at 18% and pocket the difference? This compounding effect makes a certain segment of our world very wealthy and keeps another segment mired in poverty. Which side do you want to be on? Now that you understand the massive impact of compounding on your financial health, you need to really think about savings and all that that means. What could be simpler than saving money? You earn some, you pay your bills, and then you save some at the end. Okay, I know you get that, but that's about as basic as finance gets. But how do we do it? Where do we save our money to get the best return with the highest level of security? We discussed budgeting earlier and the absolute need you have to begin the habit of saving 10% of your gross income. The need you have to be your own chief financial officer and manage your life as prudently as you would your business. Okay, so how can I do this? I know since you're paying attention to what I'm saying that I'm repeating myself. I'm consciously doing that because there is nothing more important in your financial health than you developing this fanatical adherence to the notion of saving 10%, never spending your capital, and compounding that money as well as you possibly can. A person who saves 10% of their income can, in fact, retire relatively well off. Here's a statistic. If you earned the average income beginning in 1969 of $9,000, and as we preach, saved 10% or $900, and furthermore, you increased each year only with inflation to maintain that average income, after a 40-year work life, you would be earning $48,500 in income and saving $4,850 a year. Your 10% savings now would have amounted to $115,000. Not so much to retire on, is it? Well, let's throw on the magic of compounding. Let's assume that over this 40-year life, you've averaged 12% annually in your return on investment. If you think this isn't doable, by the way, let's remember that you could buy government bonds for 15% returns in the early 80s. And the 1990s gave us an enormous bull market in stocks. So yes, the past 10 years have been flat, but the prior 30 years were not. Now, with that said, 12% does require thought and understanding, so it's not all that easy, but it is something you would have been able to accomplish. So how much does our average person have, having saved only 10% each year? Well, here you go. $1,477,397. Wow, that's not bad at all. From this, the person can now draw an income of 3% of their assets, which equals the most prudent withdrawal rules from foundations, never have to work again, never have to earn more than 3% on the assets, and draw the equal income to 100% of his last year's salary. Well, now you can understand why I'm so passionate about it. This is the average person saving only 10%. Well, why then is our nation in any financial problem? Why? I'll tell you why. The average person has bought into the misrepresentations of Wall Street, Madison Avenue, and Washington, and therefore they don't save that magical 10%, and when they do, they don't understand enough about Wall Street to oversee their money and earn that return. So they fail to save the 10%, number one, and they fail to have the understanding, number two, to make sure their money is managed properly. Let's say you only save 5%. Well, they should still have close to $750,000 saved. So yes, I'm telling you that the average person can become a millionaire. It just takes discipline and life skills. We can teach you the life skills. We cannot teach you the discipline. Well, what if they save 10% but only earn 8%? Well, then they have $550,000. Do you notice something here? In the first example of cutting their contribution by 50% but retaining the 12% return, they ended up with $750,000. However, when we keep the savings rate the same but cut the return rate by 33%, they end up with much less. This proves the power of compounding beyond the shadow of a doubt. So yes, you need to have the self-discipline to save 10% of your total earnings, but you also need to have the life skills to manage your money effectively. We'll be covering the investment component in a later session. So it strikes me that Americans spend millions and millions of dollars every year learning how to get rich quick. People attend seminars on new investment strategies that can turn $1 into $100. They buy into penny stock programs and pre-IPO investments that promise huge and infinite returns. But when all is said and done, all it takes to become wealthy is to earn an average income, invest 10%, which might mean less eating out, maybe taking less expensive vacations or living in a smaller house or whatever. But that 10% can make the average American a millionaire. The side benefits of this are great as well. By the average American saving this money, there is ample capital available for entrepreneurial ventures, capital expansion for established businesses, and enough at the end to make sizable donations to charity. So as you contemplate your financial path, ask yourself this. A, do you want to really walk among the ranks of millionaires? B, are you average or above average in your ability to generate income? And C, are you really willing to commit yourself to learning enough about finance that you can smartly manage your own money, or at least understand it well enough to oversee someone who manages it for you? You make the decision today. We're here to support you and walk with you on this financial journey.
Once again, you and our listeners are gaining ground with facts and knowledge. The magic of compounding works as Steve described, and is just another important detail on your financial path to give you more financial security. Steve has discussed compounding, taxes, saving, and many other basic financial ideas. Now let's begin to look at the differences between cash flow and expenses. Now once again, Steve Beeman.
We all know the importance of having enough money in the checking account so that we don't run out or go into overdrawn status. To most of us, that's the simple definition of cash flow. But is that enough? Is it enough to just understand that when you run out of money, you're out of cash? Well, when I was much younger and I ran my first company, a cookware distributorship, it didn't take long before I learned the very critical difference between an income statement and a statement of cash flows. Most folks who don't deal in finance have ever bothered to look at the financial statement known as a cash flow statement. Now, this is required to be produced by all public companies, and it should be produced by all private companies for their own use. The fact of the matter is, cash flow is significantly different than income. And for us to graduate to a new level of financial literacy, we must grasp this concept and ingrain it in our thinking. Let's start by talking about income. When I go out and work, in return for that work, I'm paid a wage, which usually isn't enough. Well, that wage is income to me because I've earned it. It's mine and I don't have to return it to anyone. Well, most of us get that. In fact, most of us are used to reporting that income on the IRS Form 1040. Now, for some, it's not that simple, though. Some folks, me included, receive numerous types of income as we go through the year. Typically, this is classified as either earned income or unearned income, which is an investment income. Earned income can certainly include the W-2 wages you receive from an employer, but earned income can also include money paid to you outside the normal employer-employee relationship. Money earned as a consultant, perhaps. This income is paid to you as 1099 income and reported separately. Within the category of unearned income, there are also numerous payment possibilities. For example, if you loan someone money, the interest you're paid is unearned income, and it's reported as well on a Form 1099. If you own a small business which has elected to be formed as a limited liability company or a subchapter S corporation, your share of the earned income of these enterprises is reported on Form K-1 as a distribution of earnings. All of these forms of earnings share the characteristic that they're earned, they're taxable, and they don't have to be repaid to the payer. But all of us have likely received in one form or another cash from somewhere else that we do have to repay. Or perhaps we don't have to repay it, but it's not taxable. There are two primary sources here: loans we receive and gifts we receive. Loans we, of course, have to repay. Gifts we do not. These two forms of cash we receive are certainly real money, spendable just as our earned money. But they're different. They're not earned, and thus they do not show up in our income. I know this may seem subtle to some, but it's very, very relevant, and it will become all the more useful as you progress in your understanding of finance. So on your income, there are two very different types of receipts, one known as income and one known as cash flow. On the expense side of your life, there are also two different types of outflows you make. Some, like the money you spend at the grocery, is a true expense. But some of those outflows aren't expenses at all. Let's look at two examples. First, your mortgage payment. This is normally comprised of four distinct and separate areas with the acronym PITI. This stands for principal, interest, taxes, and insurance. Now, normally when you write a check for that payment, you don't think about what's behind it. But the reality is that each of those components is very different. For example, the interest you pay and the property taxes you pay may be tax deductible to you. That's certainly an important distinction. The insurance you pay is a true expense and one that you hope you'll never have to use. Well, the final component is principal. This is not an expense at all, even though your checking account has gone down the moment you wrote that check. No, this payment is for principal on your home, and that's not an expense. Rather, it's an investment in residential real estate. The second payment you make is your car payment. If you have a standard car payment financed over a period, your monthly payments are comprised of the interest and the principal reduction called for in the loan. Well, the interest is certainly an expense, but what about the principal? Is that an investment like the home payment we made? This can be a little more subjective, so let me share with you my absolute conviction. The car you own does not qualify as an investment, period. It depreciates so rapidly that you could not logically believe you have a chance to make money on your car. Now, I do understand that someone out there is going to say, but I did. I bought a car and sold it for more than it was worth. Well, either that person isn't telling the truth, or they bought a car that just happened to become a classic and they never drove it. If that's your intention, yes, a car can become an investment, but certainly not if you're planning on driving it 12, 15, or even 20,000 miles per year. Now, on a car, there's another type of arrangement which we've spoken about called a lease. This is a little off topic, but it's relevant, so I want to discuss it. As we said earlier, a lease is a financing program that takes the estimated value of the car at the end of the period and deducts that value from the total value, then divides up the remaining balance into a number of periods with some adjustments for the cost of money, that is, the interest rate. This is a pure expense as there's no principal reduction. At the end of the lease period, you simply turn in the car and walk away. Now, this, of course, presumes you'll pick up another car, of course. I mean, leases were initially developed for businesses that needed cars for their employees. It was a neat way to receive the tax deduction rather than amortizing the car as an asset purchase. Well, leases morphed over the years into consumer financial products that, quite frankly, simply allow consumers to purchase more car than they can afford. It's part of the cycle that people get into, which precludes their ability to garner wealth. Some of you may ask, why does it matter? Well, I grant you, for most people who are concerned simply about saving money in their checking account, the notion that some of the outflow is an expense and other simply is cash flow is hard to find relevant. But as our purpose is to provide you with the life skills you need to become wealthy, it's important, as we see it, to provide you an understanding of the most relevant concepts in finance, and cash flow versus expense or income is a very important concept.
Now let's move on from expenses, cash flow, and income to very important issues in today's economy and how you can prepare to move ahead of the money game. There's been a lot of discussion in the last sections on financial matters that everyone has in their lives. But we live in a tough and challenging economic time. Let's take this discussion to a higher level and join Steve as he considers how you can increase your income in today's economy.
When I was 19, home on summer break from Purdue University, I was a self-employed cookware salesman. Now, I'll talk more about that later, but the purpose for bringing this particular year up is that I had the fortune, either good or bad, to meet a man who significantly impacted, if not changed, my life. He was a very wealthy businessman from northwestern Ohio, and I had the chance to meet him on a total fluke. Yes, there's a story there, but we won't go there or you'll be listening to this all day long. Anyway, during one of our meetings, and I don't know what else to call them but meetings, he said to me, "Steve, you're just like me. You're going to end up rich." And then he said some other things better left for another story. Well, anyway, this statement, perhaps more than any statement in my life, set me on a path to both understand and execute on the body of knowledge that constitutes wealth. How do we earn it? How do we keep it? And how do we grow it? I had learned very early on that we maximize our incomes when we maximize our value to others. As I reviewed my situation, I found that I maximized my income through direct selling. The advantage of this over, say, working at a retail store was that I was paid directly for my work. There was no middleman. If I sold, I got paid. If I didn't, I didn't. This was the most basic form of small business, or a better term would really be self-employment. And that, my friends, is the first way you can increase your income, quite directly, quite simply. Enter an agreement with someone who has a product or service to sell and sell it. It's quick, it's direct, it can be lucrative, and it's also very hard indeed. Self-employment is by its nature a difficult challenge, not usually understood by those who aren't living in that space. The thing that all self-employed people have in common is that they are the ones who generate all the income. Therefore, their livelihood is contingent on their ability to generate it. There are lots of examples of self-employed people: salespeople, beauticians, lawyers, accountants, architects, and even financial professionals. Surprised? Well, yes, I did include lawyers and beauticians in the same segment. Why? Because it's true. They face the exact same issues, albeit in businesses with different value propositions. Here are the three common attributes of a self-employed person. 1, they directly provide labor to earn the money they're paid. 2, they have a scalability problem in that they themselves are the value proposition. Therefore, they have a limited upside, although in some cases it can be quite high. But 3, they enjoy complete control over their own time because they are the value proposition, and therefore they dictate the terms of their work. Subsequent to my self-employed time, I spent 7 years in the next capacity that you can use to increase income, being an employee. This is also a relatively quick and direct way to increase your income, but it's extremely competitive. Your destiny is frequently not in your control, your income is determined by someone else, and you are not the sole value proposition, but rather you're one of many who have teamed together to make the business enterprise successful. Now, this is where most folks spend their lives, and to be sure, for some, it's a terrific way to continually and regularly increase income. Raises, promotions, stock options, and bonuses can all add up to some very nice paydays. But for many, being employed by someone else can lead to a stagnation of sorts, and here's why. When you're working for someone, if you're a good employee, you're devoting 100% of your available energy to the job at hand. As a result of this, many people in employment situations find they don't have the time to think about, let alone execute on, ideas they need to become wealthy. If their employment situation isn't going to get them there, chances are they aren't going to get there. So there's 2 primary types of income generating and income increasing propositions. Yes, we're going to go further, so don't lose heart. In my life, I've lived 2 more types of situations which do make you wealthy. Subsequent to being an employee, I started a company. Now understand there's a material difference between starting a company and being self-employed. Yes, for both situations, you determine your own hours and you have the flexibility of control. But that's where the similarities end. The business owner is the owner at the core of a product or process that is valuable in the marketplace. This product or process is fully leverageable, meaning that others can fulfill the needs. Translated, you don't have to do all the work. Unlike the lawyer who sells his or her services and is limited by how many hours they can work in a given period, the business owner has a product or service that can add resources to it as it needs them to grow virtually unlimited in scale. This is quite an extraordinary situation to enjoy. Being the owner of a successful and profitable business is about the pinnacle of having something in your corner that will increase your income. Okay, it's easier said than done for sure. Let's remember that 90% of all startup businesses fail in their first year, and 90% of the remaining businesses fail in their second year. So out of 100 businesses that start up, 2 of them will be around in year 3. Not necessarily a statistic you want to run to and brag about, and not a situation that's there for the faint of heart. The 4th type of income improvement situation is the investor, which I became subsequent to the sale of the business I had built and sold. This is a rarefied circumstance where, yes, you're self-employed, but you're able to use your capital as well as capital of others to generate the income you need to thrive. The good news is you're ultimately leverageable so you can remain truly self-employed, but also enjoy the leverage of a business owner. So those are the 4 ways you can increase income. That's it. I don't know of any others. Now, there are within each category many different opportunities, and we'll discuss those as we proceed in this session. But before we get there, I want to tell you about a book that I've wanted to write all of my life, and someday I hope to get around to it. Picture this in your mind's eye, a 200-page book with a blazing cover, the absolutely, positively guaranteed way to become rich. The first 99 pages would be quite a shock as they're completely blank. That's right, nothing. And the last 99 pages are blank. Again, nothing. So the magic, you say, must be contained on the 100th page right in the middle. Of course, that's right, and here is the magic. It's assured, it's necessary, it's required, it's unavoidable, and the list of descriptors could go on and on. The secret, you see, and the one thing that no matter which of the 4 paths to increased income you take, the secret is, are you ready for this? Are you sure? Work really hard for a really long period of time. That's it. That's the secret key to unlocking earning more money. I'm sorry, but it's true. No matter what the talk show guy says, no matter what the motivational speaker says, no matter what the CD set you bought says, without that key in place, your chance of increasing your income is very small. In fact, instead of trying to do it through those methods we discussed, just go out and play the lottery and hope for the best. This simple fact has in some ways been so lost on our society today. We live in a world of fast food, instant everything, on-demand everything, so we forget, outside of potluck, wealth is earned over a long period of time by those who produce the most effort and best ideas. So given that this is a financial literacy library, and we're out to teach and empower you to really create the financial success you desire, this little notion of work hard for a really long period of time is one that I hope you'll begin to make yourself comfortable with. It's true. So no matter which of the following ideas we pursue, at the core, we must remember that developing wealth is hard and it takes time. So here we go. What are the ideas to increase your wealth in each of these 4 areas? I don't claim to have all the ideas, and in a 30-minute presentation, I can't give them all to you, but I hope at least you can begin to put a framework around the various ideas. Number 1, let's talk about self-employment. The advantage of self-employment is that you're free of the controls placed on you by others. Except, and this is a really big one, you work directly for your customers and you need them. Whether you're truly self-employed, either as a salesperson, a beautician, an architect, or a lawyer, you need clients and customers to pay the bills. The way to increase your income from self-employment is to first enhance the definition of your personal value proposition. What makes you so special? If you're an attorney, what makes you the most desirable attorney around? Your degree, your experience, your work ethic? Now, there are a lot of companies that tout work at home, and some of them are legitimate. A number of them end up being multi-level marketing, which, by the way, isn't bad as a self-employment strategy. You gain a product to sell, build a chain of people selling it for you, and they sell it for themselves. An awful lot of people have made an awful lot of money on Amway, so don't be too quick to discount it. The hard part of this is you have to do the work. Now, a key to pure self-employment is to build your value proposition so that your customers find more value in you. You can do this by furthering your degree programs, further studies, further training programs, all of these things designed to make you more valuable to your customers. Now, let's move into employment. Obviously, this is where most Americans spend their lives, and improving income from employment is something many people aren't great at, frankly. Here again, you must change your thinking to see yourself as selling your value proposition to your employer. After all, you're after more of their money, and they're only going to give that to you if either they're forced to pay it by law or if you have a higher value proposition. Now, to the extent that you are working for W-2 wages, you have to be able to switch your viewpoint to seeing yourself as your own chief financial officer. The importance of this is that unlike the other 3 categories, you must carefully budget your money and retain your capital. It's not that easy, but it's necessary. The 2 primary ways to increase your income while you're employed are A, get promoted, and B, save as much as you can to set yourself up as an investor. Here again, the improvement of your income is dependent on the improvement of your value proposition. Consider going back to get maybe another degree. Many companies will help pay for this, and with the explosion in online educational opportunities, there's no reason not to. Well, now we're getting interesting. Under the banner of business owner are a number of opportunities. Now, I believe you need to prepare yourself to invest some money to get this proposition going. Now, the key to owning a business rather than being self-employed is that you own a process that is leverageable beyond yourself. So in the world of small business owners, you can put franchises, entrepreneurs, and successful self-employed people who have successfully migrated from being the single value proposition to becoming the head of a process that can leverage them. A managing partner at a law firm, for example. Oftentimes, they spend a great deal of time managing the other attorneys. If there are enough of them, there's quite a good living to be made by being the managing partner. With regard to franchises, McDonald's is perhaps the best when measured by returns and risk. You're buying into their processes. So when you evaluate a franchise, please be aware that you are banking on the parent company having developed a business framework and process that works, and that the risk and reward are lined up that makes sense. The statistical risk of starting a business, which I mentioned earlier, is somewhat mitigated when you buy a franchise, but the failure rates are still quite high. I personally know of 2 people who bought into franchises and they ended up losing their money. Remember always, starting a business or buying a business only makes you money if the business grows and prospers. I am so tired of hearing commercials with people bragging about how many LLCs they own, how many corporations they own. Big deal. I can set up a corporation online for virtually no money in an instant. But that doesn't mean I'm making any money. Any business has to generate revenues that are in excess of its costs. I know that sounds basic, but can you imagine how many times I've had discussions with people who don't understand that fundamental rule? The only reason for you to risk your capital is to assume you can make more than you spend. And with that, you'll be economically better off. I have yet to meet a single person who really wants to lose money. Now, I have met some who have altruistic goals of helping people, very similar to what we're doing here at the Steve Beeman Group. For those, there's a new business structure called an L3C, which is a cross between a for-profit LLC and a nonprofit structure. This is kind of a cool thing. It still does require, though, that the enterprise generate more in revenues than it pays in cost, or it will cease to exist. The final structure is the investor. Now, I'll be honest, this is a cool space to find yourself. I achieved this position after having participated in all 3 of the above structures and then accumulating enough capital to become an investor. Okay, there is a critical, albeit common sense notion that you need to understand. Investing is designed to do one of 2 things: either preserve your accumulated wealth or increase your accumulated wealth. That sounds simple, right? Well, there are horror stories of people who through business ownership accumulated vast wealth and then, after entering the investing state, lost it. I read a story recently, although I can't recall the person's name, of one of the technology kings, one of the people who sold their technology company for $100 million during the peak of the tech bubble. We'll roll the clock forward to 2010, and this person had lost the vast majority of his wealth. As I recall, he was down to $6 million, which may still seem like a lot to you, but when you consider the cost of his lifestyle, it was a Chapter 11 or lose everything. This is much more common than you think. Why? Simple. Investing is not easy. In future sessions, we'll look more at investing, but for this session concerned with improving income, I want to talk about 2 specific types of investments that we read about that frankly have me very concerned. The first is the notion of day trading. Some companies out there will tell you that you can take very little capital, let's say $5,000, and turn it into $1,000 per day. Okay, let me just say this. I've spent 25 years in finance and economics, and if there was something that worked that well, I guarantee you I'd be aware of it. Now, don't get me wrong, day trading does work, and I know people who earn very good money doing it. But they know what they're doing, they're highly disciplined, and they're willing to risk their capital. If this is something you would like to do, I urge you to complete this library, gain certification from us that you've done so, and then join our Buttonwood Club. This is our private area for serious investors. The second thing is real estate. I grew up in the 1970s, a period of very high inflation, high interest rates, and high unemployment. During this time, people were, like now, continually looking to improve their incomes, and real estate looked like a way to do it. Real estate investing has some very good characteristics. First, you can use the concept of OPM, or other people's money, by buying real estate with a loan or a mortgage from the bank. Now, yes, I read my own work. I know that I reject debt generally, but there are times in the investment circumstances when debt can be beneficial. And in those times, real estate can be very attractive. Now, I've owned rental properties in the past, and I've bought and cleaned up homes for immediate flipping or resale. The one thing I can tell you is that, like anything, it's a lot harder than it looks. Tenants are a pain, period. I'm not saying it's not worth it, but don't go into a real estate investment program thinking you're just going to invest and then sit back. It doesn't work that way. You have to advertise the property for lease, screen and approve the tenants, maintain the property, and clean up after they leave. Yes, real estate is a viable business, but be prepared to work and work really hard. Now, the other hot item in real estate is buying foreclosed homes for resale. Here again, it's not as easy as it looks. First, you've got to buy a property that is truly undervalued. Just because it has a loan on it of $500,000 and you can buy it for $300,000 doesn't mean it's undervalued. What if you can only turn around and sell it for $200,000? So be careful. And I mean be very careful that you don't get hooked into a program that charges you to participate to teach you how to do these things, only then to go out and buy properties that look cheap but aren't. The other metric that you should consider carefully is your personal risk profile. How confident are you that when you take a step on an investment, your investment will pay off? And how much of your capital are you really willing to risk? Being an investor, whether it's through a day trading program or a real estate program, can take a great deal of emotional discipline. So make sure that your own risk profiles match with the type of business you want to set up. So those are the 4 ways you have at your disposal to generate and improve your income. I'm terribly sorry there are no magic bullets, no hidden secrets that are known only by a few. So here are the secrets of accumulating wealth. Work very hard for a very long period of time, spend less than you make, thus creating retained earnings, continually build your personal value proposition so that you personally become more valuable, and then once it's earned, guard your money like a hawk, and don't let greed and optimism get the best of your money as you invest it.
I don't know about you, but I've worked for many companies for 30 plus years and have been an investor. I have made and lost money and have a fairly high level of risk tolerance. The factors that were just described are crucial in understanding where we all take our employment and our money. Steve has illustrated how important these factors are, along with the idea of self-employment.